Thanks for your patience. Now it is live in YouTube also. A disclaimer, it's a webinar on financial analysis, a must skill for every banking executive. If you have already attended, that is who are watching it in YouTube, if you have already attended, it's going to be verbatim, line by line, same. So if you want to strengthen, you can continue attending the session or else you can make a royal skip. Okay, let's continue.
Let's get started with today's presentation, Financial Analysis Must Skill for Every Banking Executive. As a bank executive, why you have to understand financial analysis? Remember one thing, what is the core business of banking? The core business is lending, and how bank takes that decision? They take that lending decision by carrying out something known as credit analysis, and in that financial analysis plays a very significant role. So if you want to rise up in your organizational hierarchy in bank, you should know what is the core business of banking, and you should be in a position to take that decision as well. So for that, you have to understand the elements, the factors related to that, and in that financial analysis is very important. Financial analysis of whom? Financial analysis of borrowers. Because when they come to the bank approach for a loan, the bank should be in a position to evaluate the customer, then take a decision, and they can do that partly by carrying out financial analysis. And when I say financial analysis, it is analyzing their financial statements, the audited or the past financials, and also their estimated projected financials. And for carrying out that analysis, we are going to use three critical tools. One is financial ratio analysis, two is cash flow analysis, and three is fund flow analysis. Let's get started with financial ratio analysis. I'm going to take you through an example. Let's say there is company A and company B. Company A has reported a profit of 10 crore and company B has reported a profit of 5 crore. If I ask you which company had performed well at this point, what will be your answer?
I know it's a basic elementary question, like asking you to write ABCD, but still will participate in this. Let's make this learning even more engaging. I'll throw a poll. Okay, just participate in the poll. It's through this process we are going to learn this even better. Okay, so instead of typing out, just participate. Just select which company has performed better here. Is it company A, company B, and whoever have already attended, you better skip this poll, okay? Because you know what's next. Okay, let's see. I request all of you to participate. Please make best use of this opportunity. You will not get a similar training elsewhere. No. Okay, it's going to be a 40 seconds poll. 5, 4, 3, 2, 1. Let's see the results. And I want you to type out what is the percentage voting in favor of A. Please type out. What is the percentage voting in favor of A? What is the percentage you are seeing on screen? It means how many of you favored A? Okay, it's 90%. 90% of the participants or 90% of those who have casted vote, you have favored A. It means you said company A is performing well by looking at their profits. Okay, it's 90%, 90%, 90%. Now let's continue.
Most of you would say company A, right? Because company A has reported a profit of 10 crore. But if I supply you one piece of information, that is the sales achieved by this company, company A has achieved a sales of 100 crore and company B has achieved a sales of 25 crore. And if I ask you once again, which company has performed well now, what will be your answer?
Okay, now tell me once again, which company has performed well? Earlier, 90% of you favored company A. Let me relaunch the poll. Let me relaunch the poll. Have a look at it. Now tell me which company is performing better here. Let's see. So far, 60% voting happened, 68% voting. I request all of you to participate. Yeah, 70, more than 70% voting happened. Let's make it 80%. Okay, at least 80% voting. Only then we'll have a reasonable basis. Okay, please, whoever didn't cast your vote, please do that. Okay, now let me end the poll, share the results, have a look at the screen. Earlier, 90% favored company A, but now what we can see is it is only 17%. It means there is a drastic shift. Earlier, only 10% favored B, but now 83% of you are favoring B. Why did this happen? Why there is a drastic shift? When you took a decision based on raw data, okay, 90% of you took that decision. 90% of you said company A is performing better, but it is possible that when you take a decision based on raw data, it can go wrong. But when I supplied you additional piece of information, you had better information at your disposal and you are able to take even a better informed decision. Earlier, only 10% favored B, but now 83% of you are favoring B because you are taking a well informed quality decision. And this happened because of financial analysis. You started taking the baby steps in financial analysis. At this point, I do not want to bombard you with other things like capital, return on investment. No, no. Given these two factors, when you just look at profit, your decision, and when you are supplied the profit with sales, your decision, which gives you better informed decision. Is it scenario 1 or scenario 2? Obviously the scenario 2. It means you started doing financial analysis. So welcome to this world of financial analysis, and thanks for taking that baby step. Let's continue.
There will be a drastic shift, right? Because earlier most of you would have favored company A, but now majority of you will be favoring company B. What happened? When you looked at the standalone figure, it was deceiving because profit of 10 crore looked better than profit of 5 crore. Yes, that's true. But when you gone deeper by comparing the profit with sales, you were able to calculate the profit margin. Company A has reported a profit of 10 crore on 100 crore. It means they have a profit margin of 10%. Whereas company B has reported a profit of 5 crore on 25 crore. It means they have profit margin of 20%. So what's happening? Company B has performed well. In this case, what we have done is we have compared the profit with sales and we have calculated this ratio. Profit by sales into 100. That is what we have calculated as profitability or profit margin. Okay. So ratios are basically a relationship between two numbers which are created in a logical way. Yes, we related sales and profits, and it's a relationship between two numbers, and there was a logic in relating the sales and profit because we can measure profitability. We related current assets and current liability to numbers, and the logic is it helps us to understand the liquidity. Okay, so ratios are relationship between two numbers which are created in a logical way, and it will help us to understand the past, present and future performance, and it will also help us to understand the strengths and weaknesses of businesses. Yes, by looking at the ratio we were able to understand that in which year whether they were stronger in the past or in the present. Current ratio example. And by looking at the profitability ratio we were able to understand like which company is performing well. So we have understood the strength and weakness. So like that we can give many variations. Okay, so that's about ratios, and we are going to understand the ratios by looking at its classifications. Ratios are broadly classified into four categories. They are liquidity ratios, capital structure or leverage ratios, activity ratios and profitability ratios. First, let's get started with liquidity ratios. Already I explained what is liquidity. Liquidity is basically ability of the business to meet its short-term expenses, short-term obligations without difficulty. At this point, I just want to bring the balance sheet here. So those who don't know what is balance sheet is a simple statement which will show from where and all money had come for business and where and all that money had been used. Okay, so for business, money can come from owners, we call it as equity. Money can come from outsiders, we call it as liabilities. When money comes from outsiders, it can come with an obligation to pay within 1 year or pay after 1 year. If it comes with an obligation to pay within 1 year, we call them as short-term liabilities because we have to pay within 1 year. And using these money, which are basically raised as repayable within 1 year, which we call them as short-term liability, we can use this liability money to create asset, that is short-term asset. But if you look at this, the short-term assets are greater than short-term liability. How it is possible? Because the short-term what is raised in yellow box is smaller, but short-term assets are larger. It means this short-term assets could not have been created without the support of some long-term funds, because only a portion of short-term assets are funded by short-term liabilities. It means there got to be some remaining funds which have been used in creating short-term assets, and that's how it should be for every business. Short-term assets should be greater than short-term liabilities, because short-term liabilities are those liabilities which you have to repay within 1 year, and for repaying that you need resources. Resources will be in the form of short-term assets, so the resources should always be greater than the obligation. That's why I've captured the short-term assets as larger size and short-term liabilities as smaller size. That's how it should be for an ideal business. Okay, right. Now, to understand this liquidity concept, let's first digest this fund utilization principle.
Yeah, whatever you are seeing on screen, I mean it. This is going to be the important principle. This is going to be the key takeaway for you in this webinar. So do not miss even a single point. And if you don't have notepad and pen, please go and grab it. It's going to be the key takeaway. It's going to be the key learning. And this is going to be the life savior for many businesses, for many bankers, for many entrepreneurs and stakeholders, employees. Okay, it's going to be such a powerful principle. Okay, so whoever joined just recently, if you have notepad and pen, please type I have. If not, please go and grab it. Okay, if you already have, just type I have.
Whoever attending this webinar, whether you work in a bank or whether you are an entrepreneur or a finance manager or a chartered accountant or a cost accountant, okay, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible, because several businesses fail because of not understanding this principle. Okay, now listen. I said money for business can be raised from the owners, we call it as equity. It can be raised from outsiders, we call it as liabilities. And this liability can be short-term liability, and these short-term liability can be used for creating assets. They are called as short-term assets. But here if you look at short-term assets are greater than short-term liabilities, it means some portion of short-term assets are funded by long-term funds. I call them as long-term liabilities and equity. So this gives rise to the understanding that equity, the money contributed by the owner, is always long-term, and other long-term liabilities. Liabilities means repayable. So it can be a term loan, it can be a debenture. Okay, right. So if you look at the composition here, short-term assets are created using an entire portion of short-term liabilities and some portion of long-term funds, I call it. So you still have some more long-term funds which can be used for creating long-term assets. Now comes the fund utilization principle. If you are raising short-term funds, you can use it for creating short-term assets. It is good. If you are raising long-term funds, you can use it for creating long-term assets. That is also good. If you're raising long-term funds, you can use a portion of long-term funds for creating short-term assets. That is considered as ideal. But one thing that should never ever happen in any business is never ever use short-term funds for creating long-term assets. Never ever use short-term funds for creating long-term assets. Why do I say that? Short-term funds are raised with a promise that you will repay within 1 year. And if you want to repay within 1 year, you should have invested that money in short-term assets, because only those assets can be converted into cash within a period of 1 year, so that you can use that cash to pay back the short-term liability. On the other side, if you use the short-term liability on creating long-term assets, by very name, by very nature, they are long-term assets. It means those are all the assets which cannot be converted into cash within a period of 1 year. So you borrowed with a promise you will repay within 1 year. So when the due date approach, if you look back, you will not have short-term assets. What you will have is only long-term assets. Long-term assets, by very nature, by very definition, they cannot be converted into cash within a period of 1 year. Then you will carry sorry figure, or you will carry sorry face with your lender. Imagine that short-term liability, that short-term fund was given by a banker in the form of a cash credit or overdraft. And when they demands the repayment, and if you don't have a matching short-term assets because you have already used that money in long-term assets, what's your position? You will not be able to sell that long-term asset. But this lender, the banker who gave you that cash credit, who gave you that overdraft, will hardly wait for 90 days. 90th day they will classify the account as non-performing asset, and they will go for legal recovery measures, and that becomes the beginning of end of a business. Okay, so understand, diverting the short-term funds for long-term purpose is suicidal. Most of the business, they do not realize this. They think all money are same, but short-term money have very high pressure because they have to be settled in the short-term period. But long-term money, they are cool because you have to settle them over a period of time only. Just imagine you take a home loan, you have to pay over a period of 20 years. Your obligation will also be manageable. But for that entire home loan amount, if you go and take an overdraft, imagine the kind of pressure. Will you be able to settle that entire home loan amount within a period of 1 year? It will not happen, right? So if at all you raise an overdraft equivalent to home loan amount, and if you put that in constructing a house, it means you are not constructing a house. You are constructing something else which I don't want to mention, because it's going to put you in trouble. It will give you sleepless nights. Okay, so never ever do this. Let me give some numbers so that we can understand it better. I've raised short-term funds of 100 million, and I've used that funds to create short-term assets of 70 million only. So here comes the problem. I've raised short-term funds of 100 million, but the short-term assets what I have created out of it is only 70 million. So the question is, what happened to that remaining 30 million? And the answer is very obvious. It is not in short-term assets. They are in long-term assets. They are in long-term assets. So what I've done here, I've diverted the short-term funds of 30 million for long-term assets. And I've also raised some long-term funds of 70 million, which I've used for creating long-term assets of 70 million. So my total both sides are 170 million. But here what happened is I've raised 100 million, of which I have spent only 70 million for short-term purpose. Then I did that blunder, unpardonable mistake of diverting the short-term funds for long-term purpose, 30 million. This is going to put this business in serious trouble, because the lender, whoever have given that 30 million, they will come and ask for the payment within period of 1 year. And for paying them, I don't have short-term assets, because the existing short-term assets is only 70 million. For that there is a corresponding obligation of 70 million. Whereas for the remaining obligation of 30 million, I don't have short-term assets. What I have is only long-term assets. Long-term assets I cannot sell just like that. It will take its own time. And Those lenders will not wait till I settle my long-term assets or till I sell my long-term assets. Okay, that's where the problem starts, because bankers are permitted to wait only for 90 days. Then they have to go for legal enforcement. If it is a supplier's money, probably he'll give you 2 or 3 calls, then he'll go for legal enforcement. That's where the problem starts. Okay. So here there is a diversion of 30 million, and this 70 million they have used for a long-term purpose only. That's okay, but the blunder, the mistake, the sin what was committed here is diversion of 30 million short-term funds for long-term purpose. Okay.
For some of you, it may sound like I have used exaggerated words like sin, blunder, but let me tell you, in my decade plus banking experience, what I have seen is businesses fail, they collapse substantially because of this reason. There is even a statistics, okay, that says a study was conducted on sick units, basically the NPS. The reason was identified why they have become sick, why they have become NPA. What was the reason? Is it because of poor sales? Is it because of marketing? Is it because of competition? Is it because of quality or HR issues or legal issues? Yes, but all those contributed only 5%. It means 96%, sorry, 95% of the business units in this country failed, not because of those reasons, but because of a single reason. We call it as diversion of short-term funds for long-term purpose. 95% of the business units, they fail because of diversion of short-term funds for long-term purpose, and they don't even realize that they are diverting. And by the time they realize that they have done that mistake, that blunder, they'll be in deep trap. This was not taught to them, this was not told, and because of that they face the heat, because of that they suffer. So you have learned this now, and if you find this useful, just type useful, or if you find this super useful, just type super useful. But I'm going to place a demand. I'm going to place a demand. The demand is, please teach them. Please teach all entrepreneurs who are in your circle. Please teach all finance and banking executives who are in your circle. Tell them that this is important. If this is not taken care, because they are not taught on these lines, they were not trained on this lines. Okay, so now you got that responsibility. So you got to take an oath now. The oath is you got to teach this to others. Okay, teach this, save them. This is also kind of a virus. Okay, this is also something like COVID, and when you are doing this you may not realize, but you will get to know only when you go deeper into that, only when you get into that deep trap. So we have to protect businesses, because think of the people who are dependent on business. If one business is getting into this trap, think of the stakeholders, think of the owners, think of the lenders, think of the employees, think of the customers, everyone who are dependent on this organization. This business will get affected, but this mistake happened most of the time without realization. Okay, so please teach this. Yes, I could see the oath from Raja, Piyush, Srizai, Veerana, Keshav, Amit. Yes, many of you, so many of you, please take this oath. This is going to save that customer. This is going to save that entrepreneur, the employees who are working in that organization, the lenders who have given the loan, and that entrepreneur itself. Okay, yes, I could say thank you. Please type this IWT, simply IWT. It means you will teach this others, and this could result in a significant rescue operation for many of the businesses. Okay, yes, thank you.
With this understanding, let's get into liquidity ratios. Liquidity ratios are broadly classified into 4 ratios, and in this webinar we are going to focus on the first one that's very important, that is current ratio. So current ratio scenario should look like this, because we know how to calculate current ratio, which is current asset by current liability. Okay, but current ratio scenario should be like this, that is current assets should be greater than current liabilities, and we calculate the current ratio like this, current asset by current liability. If current assets are greater than current liability, it means the resources are greater than obligations. Okay, let me take you through three scenarios. Look at the scenario 1 where the current liabilities are given. Okay, so this is total current liability, which is 300, and the resources that are available to settle that obligation is available. Okay, so the obligation is 300, resources are 600. So I think here the liquidity position is really comfortable. If I plot this in a form of a graph, the red bar indicates the resources, blue bar is the obligation, and here you can see there is a comfort zone. We call that as positive net working capital. How I have calculated? I've compared the current assets with current liabilities. So there are excess current assets. Excess current assets means that portion of current asset is not created by current liability, but they are rather funded by long-term funds. The portion of long-term funds used for creating current asset, we technically call it as net working capital. So if a business is having positive net working capital, it is a good sign, because to that extent that business will not have liquidity pressure. Okay, here they have 600 million as current assets and 300 million is the current liability. So they have pressure only for 300 million. For the remaining 300 million, they don't have pressure because it can be settled over a period of long time. Okay, that's what we understand when current ratio is like this, like 2:1. Let me give you another scenario. Here the current liabilities is same and current assets, there is a difference. Okay, look what's happening. Current liabilities are 300 and current assets were also 300. So you have an obligation of 300 million. For that you have resources of 300 million. It looks like a perfect scenario, but that's not the case. Okay, because let's say the bank CC has become due. This 100 had become due, and you can settle that using your cash and bank balances. Then when this 200 becomes due, what are the assets you have? Only the stock and receivables. Let's say the receivables are getting converted into cash. That's good. So out of 200 you settle 100, but still you have another 100 pending. So what will you do? How will you manage? Because you cannot settle your suppliers with the stock. You purchase stock from them. You cannot pay them in stock. You have to pay them in cash, and you cannot tell them please come and take back my stock. If you say so, then that becomes end of the credit business for you. You will not get credit from any suppliers in future, because that supplier will take care of the task of negative marketing for you. Okay, so that's why I said this scenario, even though it looks like an ideal scenario, it is not ideal. It's not an ideal scenario, because some of the current assets will not come for rescue when you want them very desperately. Okay, let me take you through scenario 3. And here the current liabilities are same, whereas current assets are comparatively lesser. Look at your current liabilities, it is 300. Look at your current assets, it is 200. So here you can see the problem. You have to settle 300 million within a period of 1 year, and for settling that you have resources of only 200 million with you. You have to settle 300 million, but you have only 200 million. So how will you manage that 100 million? That's the question. Okay, that indicates this business is going to land in trouble, number one. Number two, this will also communicate their financial discipline. They've raised 300 million short-term funds. They should have created short-term assets of 300 million, but what they've created is only 200 million. So the question is, what happened to that remaining 100 million? It's very obvious they have diverted it for long-term purpose, and they have committed that sin or blunder of diverting the short-term funds for long-term purpose, which will put that business into serious trouble. Okay, so if I put that in a form of a graph, look, the blue bar is the obligation and red bar are the resources, and clearly you can see there is a shortage, and to that extent this business is in a danger zone, because here the resources are lesser than the obligations. So when your current assets are lesser than the current liability, that is current asset minus current liability, obviously your net working capital will be negative. You will have negative net working capital. Okay, so let's capture all the three scenarios here. Scenario 1, current asset 600, current liability 300, so the net working capital was 600 minus 300, 300. Net working capital means the long-term funds which were used for creating current assets. So here if you see 300 long-term funds and 300 short-term funds put together, current assets of 600 was created. And if I look at the current ratio, it is 300 by 600, it is 2:1. In scenario 2, there is no long-term fund contribution at all, and the ratio is 1:1. And in scenario 3, 200 is the current asset, 300 is the current liability. It means there is a negative net working capital. Negative net working capital indicates a diversion of short-term funds for long-term purpose. So whenever you come across a negative net working capital, it means there is a diversion of short-term funds for long-term purpose. And whenever there is a diversion of short-term funds for long-term purpose, the current ratio will also be below 1. Here, 200 current asset divided by current liability 300. 200 by 300, you are going to get the current ratio as 0.67:1. It means for every 1 rupee obligation, they have resources of only 67 paise, which clearly shows there is a shortage. Okay, and this also means that there is a diversion of fund. At this point, I want to ask you a question. Since some of you or most of you are working in bank, what is the minimum current ratio insisted by your bank? What is the minimum current ratio insisted by your bank?
Yeah, please type out. What is the minimum current ratio insisted? I could see 1.33, 1.33, some 3 or 4 1.33 is more than 1, 2, 1.33, 1, 1.33, 1.75, 1.3. Okay, the majority what I'm seeing is 1.33, but I also see some other ratios like 1.25, 1.1. Okay, see, let me tell you, it again depends upon whether the borrower is into manufacturing, is into trading, is into services. It also depends upon the industry, and it also depends upon each and every bank's risk appetite. That's why you see some banks are insisting on 1.33, some are okay with 1.1. It means they have high risk appetite. Whereas some banks which are very conservative, they'll insist like 1.5. Yeah, like Amit Kale is saying it is 1.5. Okay, so it depends. Yeah, like Vaibhav Kumar said, it also depends upon the nature of business. So each and every bank will have their loan policy guidelines, and that guidelines will spell out what is the minimum current ratio that is required. Now, most of you said 1.33. Okay, I'll take that as a base. You know why banks are insisting on a minimum current ratio of 1.33?
Shall I take a couple of minutes to explain the logic behind a minimum current ratio of 1.33? Why banks are insisting on minimum current ratio of 1.33? Shall I explain?
Please type BIO. BIO stands for bring it on, and it's going to be a logic opener for you. You will understand why banks are insisting this particular level. Okay, so the benefit is, so far you are working on it because it was an instruction given to you, insist minimum current ratio of 1.33. But with this explanation, you will understand the rationale, and I can give you an assurance you will start falling in love with what you do. Okay,
Okay. Let's say I have current assets of 100 million and current liabilities of 75 million. And with this information, if I calculate the current ratio, it will be current assets by current liability, and it is 100 by 75. So it is 1.33. 100 by 75, and it is 1.33. So what I can infer is, when my current ratio is 1.33, it means 75% of the current assets are funded by current liabilities. And what is even more important is the remaining 25% of the current assets, that is current asset minus current liability, the remaining 25% of the current assets are funded by long-term funds. Funded by long-term funds, we technically call them as net working capital. So when the current ratio is 1.33, we can safely conclude that 25% of the current assets are funded by long-term funds. It means there is a 25% long-term fund contribution for creating current assets, and that's what most of the banks stipulate as margin for working capital. For example, if you go and check the sanction letter issued by most of the banks, they would have stipulated 25% margin for working capital credit facilities. Even if you look at the Tandon Committee recommendation for arriving at working capital, they said that 25% of the current assets have to be funded by margin, and it is only the remaining 75% banks can explore funding. Okay, it means there should be a 25% contribution of long-term funds for creating current assets, and that is verified or that is checked through current ratio. If current ratio is 1.33, then there is 25% contribution. If it is greater than 1.33, then there is greater than 25% contribution, and if it is less than 1.33, then there is less than 25% contribution, and that's the reason most of the banks insist on current ratio of 1.33. Okay.
So this is the logic behind minimum current ratio of 1.33. It's not a rocket science, but it's the logic. And once you appreciate the logic, things will become very simple. And as I said, you will start falling in love with what you do. So how many of you find this useful? How many of you find this super useful? Just type bulb on. It means you got that logic open today. And I always love to see this bulb on comment, because that personally gives me a satisfaction, because students are learning from what I teach, which is my core job. Thank you very much. And I see as a certificate of appreciation itself for my job. Thank you. Thanks a lot.
Now let's move on to capital structure ratios. Under that, there are three ratios, but here we are going to discuss about what is important from bankers' point of view, that is debt to equity ratio. In debt to equity ratio, what we'll be doing is we'll be comparing the debt with equity to understand the long-term solvency of a business. Let me take you through a balance sheet. I'm just going to show you the left-hand side, that is the equity and liability side. Look at this, shareholder funds are 100, bank loan is 100, debentures are 100, and sundry creditors are 200 million. It means this business has raised 500 million from four different parties: owners 100 million, from bankers 100 million, from debenture holders by issuing debentures 100 million, and from suppliers, sundry creditors 200 million. Now what we have to do, what we are trying to understand, it is debt equity ratio. So we have to compare the debt with equity. Equity is the owner's money. In this case, it is this 100. And debt is the sum of all the three. We call them as outside liabilities, and it is 400. So let's compare the debt with equity. Debt is 400. Equity is 100, and the formula for debt equity ratio is debt divided by equity, 400 by 100. We get the value as 4. Let me take you through a scenario, a three-case scenario, so that we can understand it better. The first scenario what we are discussing now is total outside liabilities of 400, equity, the money contributed by the owners, as well as the profits that are attributable to them put together, we call it as equity, 100. So if I calculate the debt equity, that is total outside liabilities divided by equity, 400 by 100, I get the value as 1, and we express it as 4:1. It means for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. For every 1 rupee contributed by the owner, this business has borrowed 4 rupees. So what we can understand, if this business is raising 5 rupees, 4 out of 5 rupees is by outsiders and 1 out of 5 is contributed by the owners. That's what you see here. Outsider share are 4 out of 5, that is 80%, and owner's share are 1 out of 5, that is 20%. So what's happening here? In this business, owner's stake is very less. whereas outsiders have contributed more. And I see this as highly risky proposition, because this 80% of the funds which had come into the business would not have come free. They would have come with a cost, and these costs have to be met, let whatever be the situations surrounding the business or affecting the business, because they are all fixed cost. Look at this, in this case 400 million they have raised as debt, and they have to pay interest, they have to pay principal, let whatever be the market condition. Only in rare exceptional circumstances the regulators will step in and give direction to the banking system to not to demand for payment for some time, like what we have COVID. Reserve Bank came and said give them moratorium for 3 months, then give moratorium for another 3 months. Okay, but it will not happen every year. It happens only in rare situations. So in this case, this 400 million, they have an obligation, and that has a fixed cost in the form of interest, in the form of loan principal repayment, and they have to be met. And if for some or the other reason, if their sales comes down, and if they are not in a position to meet that commitment, meet that obligation, this business will get affected to the core. Because whoever have given money, they'll not wait for long. They go for legal recourses, and that could come as a big blow for the normal operations of this business. Okay, so that's why I say 4:1 is a highly risky scenario. Let me give you a second scenario where the outside liabilities are 333 and equity is 167. I chose these numbers to convey an important message, because look, the total funds are 500. Here also it is 500 only, but I've chosen a different proportion. The proportion works like this: if you take the debt 333 and if you divide it by equity of 167, you get the debt equity ratio as 2. We express it as 2:1. It means for every 1 rupee contributed by the owners, this business is borrowing 2 rupees. It means if this business is raising 3 rupees, 2 out of 3, that is 2/3, that is 67% is coming from outsiders, and 1 out of 3, that is 33% is coming from owners. And for me, this is much better than scenario 1. In scenario 1, outsiders contribution are 80%, where in scenario 2 it is only 67%. To that extent, there will be reduction in fixed cost as well. In scenario 1, owners have contributed only 20%. In scenario 2, owners are contributing 33%. I see that as a good sign, because owners will be investing more of their money when they see their business is more promising. Let me take you through scenario 3, where total outside liabilities are 250 and equity is 250. Again, I have maintained the total as 500, but I have changed the proportion. So what is the debt equity ratio now? 250 by 250, it is 1:1. It means if this business is raising 2 rupees, 1 out of 2, that is 50% share, is coming from outsiders, and 1 out of 2, 50% share is coming from owners. And this is much better than the first and the second scenario, because here the outsiders share have come down, and as a result the fixed cost related to that will also come down, fixed commitment, fixed obligation will come down. This will reduce the burden, it will reduce the pressure on the business. And owners are investing 50%. It means they know this business is very much promising, that's why they are committing their money. So what is an indication? The indication is scenario 1 attracts high financial risk. Scenario 2 we say ideal, and scenario 3 is the best. Okay, so this ratio, that is debt equity ratio, or we call it as TOL, total outside liability, by TNW, that's basically the equity. Okay, that communicates the long-term solvency. Businesses with a high risk, businesses with high level of ratio will have a high financial risk, and because of that, it's possible that during recessionary market conditions, those businesses may not be able to withstand, they'll get washed away. Because when their sales comes down, and if their fixed cost is going to remain fixed only, it means the impact is reduced sale, higher fixed cost, so the profit will turn out to be loss, and that business will have its natural death. Okay, so that's what we are trying to understand through this debt equity ratio. So whoever working in bank, you will know, because you will be carrying out credit rating of the customers, and in my experience the highest weightage is given for the single ratio, that is debt equity, or we call it as total outside liability by tangible net worth.
So I hope you got the importance of debt equity ratio. This is the ratio which generally carries the highest weightage in credit rating. Now I just want to know, what is the maximum debt equity ratio tolerable by your bank? Just type the ratio. Is it 2 is to 1, 3 is to 1, 4 is to 1, 5 is to 1, whatever be the ratio, just type. Yeah, see, Ankita is saying 4 is to 1, Prabhudas is saying 3 is to 1. Prabhudas is our banking premium member, I believe. Yeah. Piyush 3 is to 1, Malay 4 is to 1, Ashish 3, Deepesh is saying 2 is to 1. So see here itself, we can see the variation. So this depends upon the risk aptitude of the banks. Number one, it could also vary based on the industry. It could vary based on sector. It could vary based on whether they are into manufacturing, trade, services. Okay, right.
Let's move on to the next very important topic, that is working capital holding levels. As a banker, this is very critical for you, because when you sanction working capital credit facilities like cash credit, you have to understand what is the working capital holding levels, because that only influences the working capital credit facilities. Okay, let's get started. This working capital holding levels can be subclassified into inventory holding period, debtors collection period, and creditors payment period. I'll take you through one by one. The first one is inventory holding period. I'll take you through two scenarios, scenario 1 and 2. In scenario 1, I'm giving you information about cost of sales. Cost of sales is 120 million. So please note, here I'm not giving you the sales information, rather what I'm giving you is cost of sales. So this excludes profit. Okay. Now, when they achieved a cost of sales of 120 million, they are maintaining an average inventory of 10 million. So how to look at this? In one full year, they have sold goods, and for that the cost what they have incurred is 120 million, and on an average always they maintain an inventory of 10 million. This is scenario 1. Scenario 2 also, cost of sales is same 120 million, but average inventory what they maintain is 60 million. Okay, now let's see. We have annual cost of sales. Now I can easily find out monthly cost of sales by taking the annual cost of sales divided by 12. So 120 by 10 will give me monthly cost of sales, which is 10 million in scenario 1, and scenario 2 also it is 10 million only, because my cost of sales is 120 million. Now I have two critical information. One is monthly cost of sale. I also have information about average inventory. Look at the scenario 1. The average inventory maintained is 10 million, and monthly cost of sales is also 10 million. So I can say the average inventory maintained is equal to 1 month cost of sale. Whereas if you look at scenario 2, average inventory is 60 million, whereas monthly cost of sales is 10 million. So I can say the average inventory is 6 times of monthly cost of sales. How I derived this? Basically I derived inventory holding period. I just took average inventory, I divided it by monthly cost of sale. In scenario 1, 10 million by 10 million gave me the value as 1. It means this business is maintaining inventory equivalent to 1 month cost of sale. Whereas in scenario 2, they are maintaining inventory of 60 million divided by 10 million. It means they are maintaining inventory equivalent to 6 months cost of sale. So this will communicate a lot to the bankers. Because when a customer is maintaining inventory only for a period of 1 month, their profitability will be more, because they are not locking their money in inventory, because they keep less of inventory, but they were able to achieve sales. It means there is a kind of rotation happening, turnover is happening. Whereas if you look at scenario 2, they are maintaining inventory for 6 months. It means they are going to have several other costs, and because of that their profitability will be less. It means they have to spend on storage cost. There is a possibility that goods will get damaged. They have to spend on finance cost, because their money is locked for 6 months in godown. They have to find alternate money. They come to bank itself for a loan, and that comes with a finance cost which will have impact on the profitability. On the other side, instead of bank money, if they are putting their own money, there is an opportunity cost because that money could have been invested elsewhere, which could have got them even a better return because now it is just coming to fund what is locked in the godown. Okay, so these kind of impacts can be assessed by looking at the inventory holding period. So when the inventory holding period is less, that business will have more profitability. And when inventory holding period is more, when it is beyond the industry benchmarks, when it is beyond the past levels, that will have impact on the profitability. Okay. Next, we'll move on to debtors collection period. I'm going to take you through a similar scenario. Scenario 1 and 2. And here what I'm giving you is annual credit sales. In scenario 1, annual credit sales is 120 million and average debtors is 10 million. In scenario 2, it is 120 million, but their average debtors is 40 million. Okay. Now we know annual credit sale. So let us find out monthly credit sale, which is nothing but annual credit sale divided by 12 months. 120 by 12, it is 10 and 10 in both scenarios. Now you just compare this average debtors with monthly credit sale. Monthly credit sales is 10 million and debtors is also 10 million. So we can say debtors is equal to 1 month sale. But in scenario 2, debtors is 40 million, whereas monthly credit sales is only 10 million. So we can say the debtors is 4 times of monthly credit sale. So we can express that as debtors collection period, which is nothing but the average debtors divided by monthly credit sale. In scenario 1, it is 10 by 10. It means this business is taking 1 month to collect money from its customers. Whereas in scenario 2, it is 40 divided by 10. It means this business is taking 4 months to collect money from its customers. So here we get the message. The message is in scenario 1, the collection is happening at a faster pace. Whereas in scenario 2, it's slower because they're taking 4 months to get their money back. And what will be the impact? This slow collection will have impact like liquidity strain because your money is locked with the customer. So you have to manage your show by borrowing from bank or elsewhere. So that comes with a finance cost and which will have impact on the profitability. And when you give it on credit, especially for a longer period, or when the customers are taking longer period to pay you, there is a possibility that they may end up not paying also. So bad debt losses. And when you bring in your own money to manage because of this funds getting locked here, there is an opportunity cost. Okay, so this is debtors collection period. In the same way, we can also interpret creditors payment period. Let me put all the numbers here because it's very similar to the debtors collection period what we have discussed. Okay, look at here. Scenario 1, the monthly credit purchases is 10 million. Average creditors is also 10 million. So we were able to conclude that they are taking 1 month to make payment to the creditors. Whereas in scenario 2, they are taking 4 months to make payment to the creditors. So what that means, it basically communicates the payment speed. In scenario 1, the payment is happening at a faster pace. It's good for the business. In scenario 2, the payment is happening at a slower pace. Here, the decision that payment is happening at a slower pace should be arrived only by comparing with the credit period what is offered by the creditors. If the creditor themselves are giving 4 months credit period, then that is not an issue. But if the creditors are giving only 1 month period and if this business is taking 4 months to settle the creditors, then that indicates various other things. Because slow payment could mean that this business is not having enough money to make payment to the creditors. It means they are having liquidity strain. And when the payment period is getting extended, there will be high finance costs because the suppliers will load penal charges. And when creditors are not paid on time, then the creditors can even go for a legal recovery action. So it could also indicate potential future problems. Okay, so these kind of inferences are possible by looking at the working capital holding periods, basically the inventory holding period, debtors collection period, and creditors payment period. Next,
Sorry for that. So before we proceed further, what we have discussed now is the working capital holding levels. This is very, very critical if your bank is into working capital lending, that is the cash credit, overdraft, whatever. If it is into working capital lending, then those working capital holding levels are very, very important. Okay, we'll continue.
move on to coverage ratio. In that, first I'm going to explain debt service coverage ratio. We call it as DSCR. This ratio is calculated to measure the repayment capacity of a borrower when he approaches a bank for a term loan. So how repayment capacity is measured? It is measured by finding out the cash profit available for debt service and comparing that with the repayment obligation for every year, which is interest plus principal. So here, how this cash profit available for debt service is computed. Let me show. What we do is we take profit after tax and dividend. With that, depreciation will be added back. Reason being, depreciation is a non-cash item. Not even a single penny cash goes out in the name of depreciation. Okay, since we want to find out cash profit, what we do, we add back depreciation, because while arriving at the profit after tax, this depreciation was subtracted as an expense, but no cash goes out, so we are adding back depreciation. Then we are also adding interest, not because it is a non-cash item, but because we want to know what is the cash profit available for paying interest and principal. If you want to know what is the cash profit available for paying interest and principal, you cannot take cash profit which is after paying interest. Okay, because we are starting with profit after tax and dividend, right? This profit after tax was arrived after subtracting all expenses, which also include interest. So let us add back that so that it gets nullified. So by doing this, taking profit after tax and dividend, and by adding depreciation and interest, we arrive at cash profit, and this is the formula followed by most of the bankers. Let me take you through an example so that you can understand it better. Look at this statement. This particular business has made a sales of 1000. Their direct cost is 500. Their gross profit is 500. Operating expenses are 100. Depreciation is 100. Interest on loan is 100. So from sales, direct cost was deducted 500. They had a gross profit of 500, and we are deducting three expenses. So from gross profit, when we deduct all the three expenses, we get the profit before tax. So 500 minus 300, you have as 200. From that, let's deduct tax at 50%, which is 100. So you get profit after tax of 100. Now listen. For computing debt service coverage ratio, what we have to do? We have to take profit after tax. With that, we have to add back depreciation and interest on loan. In this case, there is no dividend, so we are starting with profit after tax. So 100 plus 100 plus 100, 300. This becomes the cash profit. This cash profit have to be compared with the repayment obligation, which is basically interest on loan of 100, what we have seen, plus interest on principal I am giving you, which is 100. So what is the total obligation? 200. What is the cash profit? 300. Now we can find out debt service coverage ratio. DSCR is equal to profit after tax and dividend plus interest on term loan plus depreciation divided by interest plus principal. In this case, it is 300 divided by 200, and you get as 1.5 times. You get the value as what? 1.5 times. And what does that communicate? For every 1 rupee loan obligation, which is interest plus principal, this business is having a cash profit of 1 rupee 50 paise. So it looks good, right? Because for paying 1 rupee, they are having a cash profit of 1 rupee 50 paise. It means from 1 rupee 50 paise, 1 rupee can be paid off. Still 50 paise is available with that business. They can use that 50 paise for supporting their working capital requirements. Okay, right. Now I want to ask you a question. What is the minimum DSCR insisted by most of the banks? If you're working in a bank or if you are exposed to this concept, please give your answer. What is the minimum DSCR insisted by most of the banks?
Yeah. So I could see the ratio like 2, 1, 1.25, 1.75, 1.5, 1.75, 1.25, 2. Okay, so we have different bankers here. So the different ratios, but the ratio cannot be 0.75. Okay, I think Deepesh, please check. It cannot be 0.75. It got to be greater than 1. It got to be greater than 1. Okay, let's continue.
Okay. 1.1 will be insisted by the banks who are ready to take risk. okay, because 1.1 is a very small ratio. If they are okay with that, it means they are willing to take more risk. It means the side effect is the interest rate will be very high. 1.5 is accepted by most of the bankers, and 1.75 is insisted by public sector banks, okay, who are very conservative. They'll be insisting a DSCR of 1.75. Now, uh, let me take couple of minutes to explain the DSCR rationale, why some banks are insisting on 1.75 times, or say for that matter even 1.5 times. Why banks are insisting on DSCR of 1.5 or 1.75 and not just 1? Because if DSCR is 1 for paying loan obligation of 1, they are having resources of 1, why not banks stop with that? Why they are insisting on 1.5 or 1.75? Shall I explain?
Yeah, please type BIO. So once again, I'll take this opportunity to open up the logic. So this is going to be a logic opener, and for sure you will appreciate it. Thank you.
Okay, let me explain the rationale behind this minimum DSCR. Look at this. If DSCR is 1.75 is to 1, it means for every 1 rupee obligation there is a cash profit of 1 rupee 75 paise. So from 1 rupee 75 paise, 1 rupee can be paid, and what is left with the business is this 75 paise. This 75 paise is the profit after tax, after dividend, after paying interest, and after paying principal also. So it basically goes as retained profit, and this retained profit will go to a head called reserves and surplus in balance sheet under the head equity. And equity along with other long-term liabilities will become long-term funds, and that long-term funds can be used for supporting working capital margin. If this does not make sense for you, worry not. Look at this. Your statement of profit and loss only communicates what is profit. From that we calculate cash profit. Then we compare that with the obligation and we arrive at DSCR. And if DSCR is 1.75, it means out of 1.75, 1 can be paid, 0.75 can be retained in the business. And I told you that this retained profit will go to balance sheet under the head reserves and surplus. So now this reserves and surplus along with capital will be called as equity, and this equity along with the long-term liabilities will be called as long-term funds. These long-term funds can be considered or can be used for creating long-term assets. I repeat, these long-term liabilities can be used for creating long-term assets. But if you look at the proportion, look, you have so much of long-term funds, but only a portion of long-term funds has been used for creating long-term assets. It means there is some surplus. So what's going to happen here? This business is also raising some short-term funds. It is creating short-term assets. The short-term assets are more than the short-term funds. How it was made possible? Because short-term funds are very small, but short-term assets are much bigger than that. It was made possible because the remaining surplus of long-term funds, the remaining surplus of long-term funds has been utilized for creating this short-term assets. Now try to link with our fund utilization principle. We said a portion of current asset should be funded by short-term funds and another portion should be funded by long-term funds, because I said I marked it as ideal. Utilizing the long-term funds for creating short-term assets is ideal because that is going to relieve the business from liquidity pressure. So if a business is having a DSCR of 1.75, that 0.75 gets retained in the business. It gets retained, it becomes part of long-term funds. So that long-term funds, after being utilized for creating long-term assets, there will be some surplus. That surplus will in turn get utilized for short-term assets, and this is what we call as long-term funds used for creating short-term assets. Technically this is the net working capital. Okay, so it is not that mere profit along with capital along with long-term liability, they all become put together long-term funds, and they are actually supporting short-term asset creation. So this is the logic. I hope you would have understood.
I am sure you would have got the logic behind DSCR. Why not just one? Why 1.1? Why 1.3, 1.5, 1.75, as the case may be? Here, I took the base as 1.75, which you can relate with 1.5 to 1.1, as the case may be. So it's not mere coverage. It has something even more in depth, even more deeper. Okay. Yes, I could see. Thanks a lot. Thanks a lot. We'll continue.
Next, there are general profitability ratios. Within that, you have 5 set of ratios where basically you will be comparing the profits with sales. And there are also return on investment ratios. There are also return on investment ratios where the profits will be compared with investments, capital employed, owner's money. But I'm not getting into these because we have some more minutes where we have to touch on the cash flow and fund flow. So I'll take your approval and get started with cash flow analysis. Here I need your participation. Look at this. There is a company which has made or achieved a sales of 100 crore by incurring expenses of 60 crore and reporting profit of 40 crores. So now I have a question for you. The question is, what is the cash generated by this business? Sales is 100, expenses are 60, profit is 40. So what is the cash generated by this business?
So again, this is a kind of elementary question like what I asked you in ratios, but still, let's take that baby step once again, because here this is with reference to cash flows. Earlier, that was with reference to ratios. Okay, so whatever answer that comes to your mind with this limited information, tell me. And if you cannot give any answer because of limited information, you can say that as well. Okay, you can say inadequate information. Yeah, I could see 100 crore, 100 crore. Vishnu is saying 40 crore. Uh, yeah, Atul is also saying 40. Kasturi is saying 100. Okay, okay, let's see.
The cash generation can be equal to profit when they have realized their entire sales of 100 crore and met their or paid their entire expenses of 60 crore. It means 100 crore had come in and 60 crore had gone out. So the profit will be equal to cash. But it can also be greater than 40 crore. It can also be less than 40 crore. It can be greater than 40 crore when you have realized the entire sales and you have paid only part of the expenses. So here you have cash as 70 crore. And it can be less than 40 crore when you have realized only the part of the sales and you have paid full expenses, okay, or most of the expenses. So you have realized only 70 crore but you have paid entire 60 crore. So here your cash is only 10 crore, okay. And this can also undergo a change. This cash of 70 crore can come below 40 crore. It can even come below it can come below 70 crore. It can even come below 40 crore. And this cash of 10 crore can go above 10 crore. It can even go above 40 crore. How? Let's say a loan has been repaid 40 crore. Some machinery has been purchased for 20 crore. It means out of 70, 60 crore gone. So what is the cash position? It's now only 10 crore. And in the second scenario, let's say a debenture has been raised, money has come in for 30 crore. Some asset has been sold, 20 crore money had come in. Equity, money had come in from owners 20 crore. So we have 70 crore money coming in. So now the total position is 80 crore. So what we have to understand is in business, cash is not generated merely by profit. It is from various activities. We call them as cash flows from operating activity, cash flows from investment activity, and cash flows from financing activity. Look at this 70 crore. This is a cash flow from operations, operating activity. Whereas this 40 crore repaid is a result of financing activity. They raised finance in the past. They are repaying that now, financing activity. Look at this machinery purchase 20 crore. They are investing their money. It's an investment activity. Whereas this debenture of 30 crore money coming in is the result of financing activity. And they have sold assets 20 crore. They are disposing of their investments as a result of investment activity. Whereas this equity 20 crore which had come in is a result of financing activity. And finally, the 10 crore cash is a result of operating activity. So what we can infer is in business, cash can come in and go out under three activities. operating activity, investment activity, and financing activity. So in a year, if you capture all this, cash flows from operating, investment, and financing activity, and if you total them, you get to know what is the cash generated during the year. And with this, if you add the opening cash and equivalents, automatically you will get the closing cash position, closing cash and cash equivalents position. And this is something known as abridged cash flow statement. So what's happening here? I'm capturing the cash flows from operating activity, investment activity, financing activity. I'm aggregating them so that I can get the cash generated during the year. And with this, when I add the opening cash balance, automatically I get the closing cash balance. Okay. So this statement, by having a look at this statement, I'll get to know from where money had come and where money had gone out. Okay, and it also acts as a reconciliation statement, because by adding the cash generated during the year with the opening balance, I get the closing balance. Let me show you a real life cash flow statement. It will look something like this with many line items and subline items. But being part of bank executive, being part of bank, your focus should be on how to read the cash flow statement, because the preparation of cash flow statements are taken care by accountants. So you should know where you have to keep your eyes. Okay, look at this cash flow from operating activity. It's a positive figure of 4,60,600. Look at this investment activity. It is a negative figure of 1,75,000. So the positive figure of 4,60,600 from operating activity means they've run their business for one full year, and from operations they've made a positive cash. Whereas investment activity negative figure means they have paid 1,75,000. Cash had gone out to the extent of 1,75,000 because they have made some investments. So some other assets have come in. So if you want to know what are those assets, you have to go back to the statement. Look, they have purchased plant and machinery. They have purchased some investments. Then look at the next key item, that is investment activity. Sorry, financing activity. The next key item is financing activity, and it is a negative cash of 2,70,000. It means to that extent cash had gone out. And if you want to know what are those components, you can go to the cash flow statement and you can see. And now if you add all the three, you get to know what is the cash generated during the year, and it's 15,600. So when I look at this, what I infer is they made 4,60,600 from their operations, and they use their own money for making some investments. And despite spending on investment, they had so much of money, so they are very easily settling their financial obligations. And despite all this, they still have positive cash of 15,600. And here we need not worry because they made so much of money, but everything has gone out. We need not worry because look at their opening cash and cash equivalent position. They already had 1,50,000. So this 1,50,000 plus what they've made during the year, if you add, still at the end of the year, their position is really comfortable. It's actually better than the previous year. Previous year it was 1,50,000, and at the end of the current year it is 1,65,600. So when I look at the cash flow statement, things are looking too good. But you should also be very cautious, because sometimes businesses will be showing good amount of profits, but cash flows from operating activity will be negative. It's because most of their sales are logged with the customers, or most of the money is logged in the inventories. So because of that, cash flows are not happening, so they'll be struggling. So for a healthy business, what is required is a positive cash flow from operating activity. Look at their investment activities. Is it positive or negative? Positive means they are disposing of their investments. They are getting some money out of investments. If they are disposing of their investments, if they are selling their investments, what assets are they selling? Are they selling the core assets or non-core assets? If they are selling the core assets, then the question of going concern will arise. Because by selling their core assets, how they will continue their operations in future? Or if they are selling their non-core assets, it's a good strategy, because they are infusing liquidity into the business by disposing of the assets which are not required for running the show. Look at their financing activity. If it is a positive figure, it means money had come into the business. From whom that money had come? Is it from owners? Is it from outsiders? What are the terms? All those can be explored and it can be understood. So these kind of critical information are possible by going through cash flow statement. Okay, and I'll take some more minutes, a couple of minutes, not couple of minutes, some 3 to 5 minutes to explain fund flow analysis. I need your participation here. Look at this. There are three companies A, B, C, and you have information about their long-term sources and short-term sources, total sources. You have information about their long-term uses, short-term uses, and total uses. I want you to digest this information. I want you to digest this information. Spend some time and then identify which company is in trouble here. Is it company A or company B or company C? Company A, they've raised long-term funds of 50. They've raised short-term funds of 50. So total of 100, of which 50 is used for long-term, 50 is used for short-term. Company B also raised in the same pattern, but of which 70 is used for long-term and 30 only used for short-term. And C raised in the same pattern, but of which 30 only used for long-term and 70 is used for short-term. So you have to tell me like which company is in trouble. Let's see the results.
Yeah, please think over and tell me which company is in trouble, and it is possible that easily you will land in wrong picture. I mean, easily you will land in wrong company. Yeah, I could see that out of some of the answers, what was found to be so comfortable was considered as company being in trouble. Okay, so that requires we have to learn this even more in depth. Yeah. Let's see. See, actually, it's through fund flow statement we apply what was understood in fund utilization principle. Okay.
I'm going to rearrange this statement. Let me bring the long-term sources here and I'll compare that with long-term uses. So let's see what is the position. If you take company A, long-term sources and uses are same, so no surplus, no deficit. But company B, long-term source is 50, long-term use is 70, so there is a deficit of 20. And company C, long-term source is 50, long-term use is 30 only, so there is a surplus of 20. And now let me take short-term sources. I'll compare that with short-term uses. And let's see what is the position. For company A, obviously no surplus, no deficit. But company B, they raised a short-term fund of 50 and used only 30, they had a surplus of 20. And company C, they raised only 50, they've used 70, they had a deficit. So it might look like company C is in trouble because they had deficit and company B is comfortable because they had surplus, but that's not the understanding. Understanding, pay attention here. Company B, they raised a long-term source of 50, but they created a long-term use of 70. How is that possible? With 50, you cannot create 70. So from where they got the remaining 20? Obvious, they got that remaining 20 from here. So this short-term surplus of 20 with the long-term source of 50, they got money worth 70 million, which they've used for long-term purpose. And because of this reason, we say company B is in trouble. Because company B, they raised a short-term source of 50 and their short-term resources are only 30. It means they are supposed to repay 50 million in 1 year. With that promise, they raised 50 million, but what they have done is they have created only 30 million worth of resources. They have simply diverted 20 million for long-term purpose. So within 1 year, they are supposed to repay 50 million, but they have resources only 30 million with them. So whoever have given that 20 million, they'll go for legal action against this company for not fulfilling the obligation, for not fulfilling the promise. For not fulfilling the promise. In this case, company B, they'll not be in a position to fulfill the promise because that 20 million they have invested in long-term asset. Long-term use. It can be land, building, plant and machinery, and you cannot sell them just like that. It will take more than a year, but they will not wait for more than a year. Okay, that's why we say company B is in trouble. But if you look at company C, they've raised 50 million long term, they've spent only 30 million, they had a surplus of 20 million. And that surplus of 20 million along with short-term fund of 50 million, they've created short-term use of 70 million. And if you look at it from the other side, within 1 year they are supposed to pay 50 million, and for paying that 50 million, what are the resources they have? 70 million. That's why we say company C is in comfortable situation. Okay, right. So this statement which helped us to get more clarity is fund flow statement. Let me give you a real life fund flow statement. It will look something like this. Okay, it's basically part of it. Look, here you have the sources and here you have the applications. Sources we basically call as long-term sources, application we call as long-term users, like what we have seen here. Okay, now look at this. Let me analyze this also so that you will get complete clarity about fund flows analysis. And here I'm not teaching you how to prepare fund flow statement, but I'm teaching you how to read the fund flow statement. Okay, look, in 2018-19 they had long-term sources from operations and by selling investment of 5,650, and these are all their long-term uses. They purchased plant and machinery, they paid taxes, they paid dividend. Okay, so 5,650 was the source, 6,200 was the use, there was a deficit of 550. Let's analyze this. So what is the total source? It is this 5,650. Okay, when they had 5,650, what they did, they first purchased plant and machinery. Okay, not first, they purchased. Okay, all right. Since they had so much of fun, okay, 3,700 is okay, because even after paying all this, they'll have a surplus of 1,950. And then what they are supposed to do, tax is compulsory, they cannot escape. Okay, from 1,950 they paid taxes of 1,100. So they are left with 1,950 minus 1,100, 850. Okay, when they are left with 850, they did this mistake. When they are left with the long-term fund of 850 only, what they did, they went and paid dividend of 1,400. What is the amount they have? 850. But what is the dividend they have paid? It is 1,400. How? It's not acceptable, right? But they did that. How? They went and paid 1,400. They faced a shortage of 550 and they have managed that shortage by using short-term funds. Okay, so here there is a deficit, and this deficit was managed because they took some short-term funds. A simple example can be a cash credit or overdraft, because they wanted to pay 1,400 to their owners, but they have only 850. So what they did, that 850 plus money available in cash credit or overdraft to the extent of 550 put together, they have paid dividend of 1,400. So this shows their financial discipline. When they have only 850, why they are paying 1,400? That's not right, right? I mean, this is not a wise approach. Or ideally what this business should have done, when they have purchased plant and machinery of 3,700, here they should have raised some long-term funds. So some portion of this 3,700 could have been funded by long-term funds, and that would have left good amount of surplus so that they could have paid this dividend easily. Or the other way is, when they have an investment to take place like this to the extent of 3,700, why they are paying dividend? They could have used this money for funding that, right? They didn't do. They paid dividend when they don't have adequate funds. When they had only 850, they paid 1,400. They simply diverted short-term funds for long-term purpose. So this is what happened in 2018-19. In 2018-19, or ideally they could have done one thing. When they are left with the long-term funds of 850, they should have restricted their dividend to 850. In that case, there will not be any diversion of short-term funds for long-term purpose. But even it should not be like that, no, because there should be some long-term surplus contributing for working capital of the business. Here, instead of contributing, they have stolen the money from cash credit for paying as dividend to the owners. Okay, see how powerful the statement is. It is revealing what was hidden. Let's see what happened in 2019-20. In 2019-20, their funds from operations have improved significantly. They've also raised money by issuing debentures, so it is 7,800. And from that, they are purchasing plant and machinery. Okay, they have a lot of money, let them. It means after purchasing plant and machinery, they have surplus of 5,025, and they want to pay taxes. Okay, good, let them pay. So from 5,025 taxes paid, what is left over now? 3,325. From that, they want to pay dividend. Okay, let them pay 2,250. It means the balance left over is 1,075. At this point, they should have put a break. But what they did, they went and purchased an investment of 1,500. When they are left with the funds of only 1,075, it means this is the grave mistake which they should not have committed. 1075 is the surplus, 1500 investment, not in their business. They have purchased investments, some shares or stocks of some other company. By using whose money? By using some short-term money. Look, they have only 1075, but how they spent 1500? The 1075 plus 425 gave them 1500. They've invested in someone else's business. This business is not learning from its mistakes. When they are left with 1075, they should have stopped at that level. They should have ensured that this money is going for supporting the working capital requirements of the business, but they didn't do. Okay, so these kind of all hidden practices will get caught, will get revealed in fund flow statement. In my 4 year of stint in State Bank of India, the statement for which I had high regards is the fund flow statement, because this is one master health checkup report which will reveal all the hidden problems of the borrower. I mean, if at all you will get awestruck, or if at all you will become unanswerable in one statement, means that is fund flow statement, because it is so clear. Okay, because it shows, no, like from where they got money, where they have used. See, they have paid dividend in 1819 when they didn't have money. They've invested in someone else's business in 1920 when they did had money. So this all shows the intentions, the integrity of people behind the show as well, not just numbers. It also goes deeper into qualitative aspects. So that's the power of fund flow statement. So develop your skill in reading fund flow statement. Such a powerful statement. Okay, all right. So with this, I wish to conclude this presentation, and I believe most of you would have had a bulb on moment. So if you really had a bulb on moment, please type bulb on.
Yeah, please type bulb on if you enjoyed this session, if you had that learning curve, if you had learned something meaningful, useful, critical, relevant, which is going to help you in your career. Please type bulb on. Thanks a lot. Thanks a lot. What you have seen now is only the tip of the iceberg. What you have seen now is only the tip of the iceberg. But the best part is you have understood whatever I have explained so far. Thank you very much. The reason why I say it's a tip of the iceberg is because in reality, when you do the credit appraisal, when you do the financial analysis, you have to read balance sheet line by line. You should focus or put your attention on every item in balance sheet. You have to analyze various set of financial ratios. There will be liquidity, solvency, profitability, return on investment ratios, various set of ratios. Then you have to study the cash flow statements in depth. You have to focus on item by item items. You should see where they generated money, where they have used, how they have used. Then you should also study their fund flow statement in depth, and again in between the lines, to identify whether any fund diversion have taken place. Then you should develop special skill for assessing the working capital requirement of the borrower. Here you got to empathize with the borrower, but at the same time you should also protect the bank's interest. Next, you should be able to put up a comprehensive loan proposal if a borrower comes for a term loan for putting up a project, because this requires viability study. You have to look into their repayment capacity, DSCR, fire, break even, sensitivity, and so on. Next, you should also be able to work seamlessly on CMA report, the basic Excel document which captures the past financial data as well as the current estimate and projection. And from this only all kind of analysis will happen. Next, you should be able to arrive at credit risk rating for the borrower. You should be able to come across different types of business entities, business models profile, and you should also be able to understand the forex impact on import export transactions. So what all this means? All this means you got to learn more, right? So how many of you are really ready to learn more? Because once again, I reiterate, what I have showed you today is only tip of the iceberg. So how many of you are interested in learning more? If you are really interested in learning more, if you want to take this journey to the next level, if you want to improve your skills that is required for your job, and that's the fundamental for your banking career, then type ILM. ILM stands for I am interested in learning more. ILM stands for I am interested in learning more. Whoever interested, please type ILM. Thank you very much. Can I have your permission to introduce the courses which I have published for bankers, which will solve all the problems we discussed? If you're permitting me, just type yes. Just type yes. I'll take that as your approval. Thank you very much. Let me introduce the courses. But before that, whoever interested in getting certificate for this webinar, I would request you to wait for another 5 to 10 minutes. I'll be sharing a unique code which you have to fill in the mail which you'll be getting after this webinar. Then you become eligible for getting certificate of participation. And we also promised 2 ebooks, one on financial analysis and the other one on working capital management. You will get access to those ebooks in the email after this webinar. And we also promised access for a free crash course on banking credit. You will be getting access for that as well in the email. So keep an eye on the email. You'll be getting email from carajaclasses@crajaclasses.org.
Financial and Credit Analysis Mastery Bundle. It's a bundle of courses I have designed for financial and credit analysis purposes. To start with, we have course number 1, Banking Credit Analysis Process, worth rupees 499. In this course, I have covered credit analysis, financial statement reading skill, ratios, fund flows, cash flows, then types of business loans, working capital, cash credit. You can see there are more than 20, say more than 30 topics, and everything is connected with banking credit process. So that is included in this bundle. Number 2, how to carry out financial analysis as a banker. In this, you will learn financial analysis through ratios, through fund flow analysis and cash flow analysis in depth from banker point of view. Number 3 is how to carry out term loan appraisal and assessment as a banker. As we know, term loan is a technical process. It requires lot of technical analysis, and all those are covered through section 1 introduction. Section 2 covers TEV study. Section 3 talks about cost of project and means of finance. Section 4 deals with production factors. Section 5 technical analysis in term loan appraisal. Then comes course number 4, how to prepare CMA report for bank loan. In this course, through 8 sections, I have covered CMA preparation process in depth with case studies. Then comes course number 5, how to read balance sheet. In this course, I have picked up a real life balance sheet from stock exchange and have explained all these aspects. You can have a look at the screen. I'm not reading it out. Then comes course number 6, that is how to read CIBIL report. And in this course, I have explained all about CIBIL, how to read CIBIL report, covering 6 sections, namely CIBIL TransUnion score, personal information, contact information, employment information, account information, enquiry information. Then key terms related to reports were also explained through a separate section. So basically, it's a 6 courses bundle of each 499 rupees worth. So 499 into 6, the overall price is 2994. But you are special. You have attended this webinar. You have spent more than 60 minutes. It means I'm going to give you a bonus. Already 6 courses. Here comes course number 7, where you can learn banking credit analysis through case studies. Course number 8, where you can learn how to prepare cash budget for bank loans. And course number 9, which deals with credit policy, products, delivery, appraisal, risk and rating. So how many courses? Already 6. So now 9, and comes here course number 10, export finance, priority sector lending and retail loan. So 10 courses. It should be of value close to 4,990, but you are going to get it for same 2,994. It means all these 4 courses comes to you at free of cost. and you deserve even more bonus because you are sitting still this point. You have that desire to learn. So come here, course number 11, which deals with basic elements related to bank loan proposal. Course number 12, it's a comprehensive course. It's finance for non-finance executives. Many of the bank executives come from non-finance background, so this course is going to be their life savior. Then course number 13, financial statement analysis, a complete study. So now you have 13 courses of value close to 8,000 rupees, but you're going to get all for the same price of 2,994. Okay, so it's not yet over. You still have some more bonus. That is course number 14, how to carry out credit risk rating for non-trading entities. Course number 15, master class on working capital management. Course number 16, basics of forex management. So 16 courses of value close to 9,500, but you are going to get it for same 2,994. Not yet over. You have even more bonus. I'm going to give you a lot. Next comes course number 17, which is collateral securities, a comprehensive study. Course number 18, basics of SARFAESI Act. Course number 19, registration and licenses required to run a business in India. And course number 20, accounting basics in 66 minutes. So I have introduced 6 courses related to banking, financial and credit analysis, the core courses, and you are going to get free bonus of another 14 courses. It means you are going to get access to 20 courses of value close to 11,500. It's 3,000 plus lectures, and you are going to get lifetime access both in mobile apps as well as website, and all this for just price of rupees 2,994. And you are also going to get bonus access to various free resources comprising 11 ebooks. Okay, it's an ebook on current ratio, debt equity, cash flow statement, capital structuring, financial break even. It goes. I'm just running them. And you are also going to get some more bonus. It's career guidance material, basically the professional courses you can pursue while working in bank, and also a career guidance material related to certified credit professional course. And you will also get access to test series on ratio analysis. Okay, so it's 20 courses, 15 resources of value close to 13,000 rupees, 3,000 plus lectures, lifetime access, accessible in mobile app and website. All this comes to you for a price of rupees 2,994 only. So why wait for? Enroll now.
So thanks for this opportunity. I'm going to share the link. Please check your chat section. Whoever watching this in Zoom, check your chat section. Whoever watching this in YouTube, check the chat section as well as description below. I'm placing the link now, and this link is valid only for next 20 minutes. So if you want to continue your learning journey, if you want to take it to the next level, if you want to make best use of this opportunity, your time is on now. It's going to be next 20 minutes. I'll stay back, and whoever enrolls now, I'll be calling out each and every participant's name. I'll be giving my live acknowledgement and assurance. I want to ensure this entire process happens transparently. So if you believe that this webinar has added value for you, and if you want to continue your learning journey, now the ball is in your court. Please click on the link. It will take you to the course. If you already have a student account in CA Raja classes, directly you can enroll. Otherwise, it will prompt you to open up a student account, and then you can complete the enrollment registration process. Let me also share some of the feedback given by our earlier students. Just have a look at it. If you still wonder whether you should enroll in this package or not, just look back your past 60 plus minutes you have spent. Just try to answer all the 4 questions. Question 1, did you really understood what was explained? If answer is yes, whether you are able to relate with the things that were explained in this webinar. If answer is yes, if you derived value in the 60 plus minutes, and if answer is yes, and if you had that aha moment or bulb on moment that you have learned something really meaningful, useful, then I would suggest go and enroll confidently, because you will get that throughout this package, throughout the courses. That's the assurance from my side. If you have this question as to how you can access these courses, just have a look at the screen. If you enroll now, you can access them in desktop, laptop by visiting our portal. You can also install our app. We have app for Android phone users as well as iPhone users. You can download the app from Play Store, App Store. Just search for CA Raja classes, and the courses whatever you enroll will be available in the app also. And the best part is you can download the courses into your mobile within the app, and you can access them later even without internet connection. After enrolling the course, if you have some doubts or if you need some guidance, we are going to provide you 24 by 7 lifetime support through our Telegram community. We have a community for financial analysis where 1000 plus bankers have already signed up. This is only for paid students who are coming to this specific course. You can ask all your questions and you will get reply. You can also learn from question answers of other participants. So before we proceed with some of the discussions happening in Telegram community, as I mentioned, I want to keep this entire process transparent as possible. So I will show you who are enrolling. Okay, so let me just go to my desktop. Whoever enrolls now, I'll be giving my live acknowledgement. Okay, let me just open my email. Yeah. I hope my email page is visible. And yes, we have our participants. Let me call out the names. To start with, let's see who had taken that first step. Yes, that's by Aman Kumar Chandan. Aman Kumar, thank you very much. This is an acknowledgement message. Yes, I have received your fee payment, and thank you for the trust. Thank you for believing me. Thank you for investing your hard-earned money. I deeply value and respect your commitment, respect your investment. Okay, so thank you very much for investing, and welcome to our banking students community. You are going to get at least 100 times of the value for the money you have spent. That's my assurance. And whatever you are going to learn in this package will come a long way with you till, even if you become managing director of the bank, even at that point you will be applying what you are going to learn now. That's the importance of what you have invested now. Okay, so thank you very much and a warm welcome to our students community. My request is please spend 30 to 45 minutes every day consistently for 11 days. Then automatically it will become your habit. Over a period of 3 to 4 months you will be able to complete this entire package, and you will see a transformation. You will see an authority in financial analysis within yourself. You will be able to perform your job at a better pace. Okay, so thank you very much and a warm welcome to our students community. Let's move on to the next participant. Yeah, we have our second participant. Yeah, before I go to that, Rajiv Singh, I'm putting the link here. Yeah, I'm sorry, just a moment. I just missed the link. Just give me a moment. Yeah. Rajiv Singh, I'm giving you the link. You can enroll through this. Yeah, sorry for the delay. Yeah, this is by Deepa Sridharan. Deepa, thank you very much. Thanks for the trust. Thanks for investing your hard-earned money in these courses. take an acknowledgement as well as assurance from me. This is going to be one of your finest investment. You have taken an action. All action takers will get results. Okay, so you have taken your first action, that is investing in this courses, but it requires some subsequent actions as well. That is, you have to spend some quality time on these courses. It's simple. Just spend 30 to 45 minutes every day. Just spend 30 to 45 minutes. Do that consistently for 11 days. Then over a period of 3 to 4 months, you will be able to master this. You will be able to complete this. You will see a transformation. You will be able to achieve a mastery in financial analysis. That's my assurance. So thank you very much. Thanks a lot. This is my acknowledgement message, and my assurance is you will get at least 100 times of value for the money you have spent. Thank you. Yeah. Yeah, Bhardi, yes. What is your query? Yes, we have our next participant, that is Bhavna Yadav. Bhavna, thank you very much. This is an acknowledgement. Yes, I have received your fee. Thank you for the trust. Thank you for investing your hard-earned money in these courses. Thank you for believing me. Thank you for taking that one step forward. And my request is, I see you as an action taker, but you have to spend some 30 to 45 minutes every day. Please do that consistently. If you can do that consistently for next 11 days, because there is a psychology behind that. When you do that consistently for 11 days, then you will make it as a habit. Then over a period of 3 to 4 months, you will be able to achieve mastery. Okay. So thank you very much. Thanks a lot for your trust. Yeah, Sheikh Ahmed, not getting my uh, sound clearly. Okay, Sheikh Ahmed, I'll do one thing. I'll just give you my YouTube link. Just catch up in YouTube, so you should be able to listen even more clearly. Okay. Yes. Let's move on. Let's see who is our next participant. Yeah. Yes, we have our next participant. Yeah, Keshav Mali. Keshav, thank you very much, Keshav. Thanks a lot. Thanks for investing your hard-earned money. And thanks for the trust. All of you, whoever have invested, I see most of you attending today for the first time. But despite that, you are able to take this bold decision. I respect that. I value your decision, and I am always committed to that. Okay. So whoever have enrolled today, you will be getting access to our Telegram community. Whenever you come across any doubts, any queries related to banking, credit, financial analysis, you can always post. Either myself or senior members in the group will be coming out with an answer, coming out with a rescue, and you will be able to learn. So thank you very much. Thank you, Keshav Mali. And please spend that 30 to 45 minutes. Spend that 30 to 45 minutes. Yes, Gopal Krishnan, if you have enrolled, yes, you will be getting, whoever enrolling now, you will be getting a mail, you will be getting a WhatsApp message that will have complete instruction as to how you can access the courses, how you can get into the Telegram group, everything. Okay. Yeah. Next, we have our next participant. Let's see. Who is our next participant here? Yes, Gopal Krishnan. Yeah, Gopal Krishnan, thank you very much. Thanks for the trust. Thank you for investing. Please allow me, all of you, please allow me to repeat this. Repeat this. I always want to say this. This should go into my head as well. Okay. Thanks for the trust that prevails over everything here. Thanks for the trust. Thanks for committing your hard-earned money. For some, it's as good as, for some, it's as good as 10% of salary. So I deeply respect that. I value your commitment. Okay. And I will help you throughout. Okay. That's the assurance we give through our Telegram group. We give through our Telegram group. I'll show you like what are the discussions that are happening in a Telegram group once I complete this acknowledgement series. Okay. So thank you, Gopal Krishnan. So my request is you have to spend that 30 to 45 minutes every day. Today you have spent more than 60 minutes now, right? So spending 30 to 45 minutes is absolutely not a difficult task at all. And if you do that for 11 days, it is going to become your habit. And then in a period of 3 to 4 months, you are going to see a transformation. Yeah. Thank you, Gopal Krishnan. Thanks a lot. Let's see. We have our next participant. Yeah. We have our next participant, that's Amit Kumar. Amit Kumar. Okay. Bhubesh Kumar already purchased banking credit analysis process. Okay, Bhubesh Kumar, I think you would have purchased it for 499, right? You would have purchased for 499, and this bundle is 2994. Okay, just drop me a message in WhatsApp. 7736022001. This is my WhatsApp number. This message is for Bhubesh Kumar. Just drop me a message. Let's see what best can be done. Okay. Amit Kumar, thank you very much. Amit Kumar, thank you for being an action taker. Action takers get results. Action takers get results. We can just be keep on be watching videos, we can just be keep on be attending various webinars, but what next action we are going to take? Is it I'm saying this so that you can pay me money? Absolutely no. See, there are 2 lakh plus students, I'm well placed, but you have spent your time, you should get your results, you should move forward, you should complete topic by topic. Okay, because the webinars are going to be on the same topics, but you should progress, you should learn new things. Okay, for that you have to take an action, and only when you take an action you get result. So I see so many action takers today. You will not regret for the time you have spent. You are going to get value, you are going to learn new things, and when you do that consistently for 11 days, then over a period of 4 months, see, this is my assurance, over a period of 4 months. See, on what basis I'm giving you that assurance? Is it I'm just giving you left and right? No. Students who have enrolled in our courses, they come back with feedback, they come back with their happy news, they come back with their promotions. Okay, they come back with the joy that, sir, using your courses I was able to crack this promotion interview, using your courses I was able to perform your I was able to perform my job at a better pace. Okay, that's the feedback I have, and that gives me confidence to explain all this. Okay, yeah. uh, is there any time period for the course? Is it necessary to spend 45 minutes, or can I go through classes? See, you can go through classes anytime. What I'm giving you is lifetime access. No one in the market will give lifetime access. I'm giving you lifetime access. You can watch it any number of time. You can watch it 3 years, 5 years. Okay, but this lifetime access is a curse, because since it is available anytime, it will be taken for granted. That's why I'm insisting you to create a schedule now, that is 45 minutes every day. Reserve a time, either early morning hours or late evening. Reserve a time, then stick to that schedule for 11 days. Then automatically it will become your habit. Then you will get the benefit, you will get the return on investment. If you are investing 2994, you should get return on investment, right? That should happen at the earliest. Your payback period should be as early as possible. That's why I'm saying please do it at the earliest. But yes, you get lifetime access. Okay, so whenever you want to access, you can, because the data what I have shows students who have enrolled 4 years back, they even now come and access the lectures now and then whenever they require a clarity or a clarification. Okay, so is that helpful? Thank you. And let's see who else. Yes, we have our next participant. This is Vivek Patel. Vivek, thank you very much, Vivek. This is an acknowledgement message. This is an assurance message. Acknowledgement, I have received your fee. Assurance, this is going to be one of your finest investment. Why? Because you are going to get 100 times of value for the money you have spent. I am saying that with a lot of courage. I'm saying that with a lot of conviction, because I have data. I have feedback from students. I have feedback from bank executives who have enrolled in our courses. They have seen that transformation. Okay, with that comfort only, I'm giving you that assurance. And these are all the courses I have created based on my experience. They are not theory. I'm not teaching here theoretical thing for examination purpose. No, everything. Okay, yeah. Rajiv Singh. Yes, Rajiv, thanks a lot. Thank you. Thank you very much. So all of you, warm welcome to our students community. What you are going to get here is 100 times of value. I'm not exaggerating. I'm not saying. See, generally, what we'll say is like if you spend 1 rupee on something, you should get at least 5 rupees or 10 rupees of value. But I'm saying you are spending 1 rupee on our courses, and I'm going to give you value worth 100 rupees. Okay, that's the commitment I'm giving you. Okay, and our Telegram community, which is going to act as a lifetime support for you, will add up that value in multifold ways. Okay, so thank you very much. And we have our next participant. Yeah, we have our next participant. Let's see. That's by Rajiv Kumar Singh. Yes, Rajiv Kumar, I have seen your message and here is my acknowledgement. Yes, thanks a lot. Thanks for the trust. Thanks for investing your hard-earned money. All of you. Yes, I deeply value that. It's hard-earned money because most of you are working executives. It means you are not into business. Okay. It means you get that fixed income, and in that you have taken the decision to commit a portion of it for upskilling yourself. So I deeply respect that. Please spend that 30 to 45 minutes every day. If you do so, it's going to be one of your finest investment. You will see transformation. For sure, you will come back to me and say that, sir, your courses have helped us in achieving this promotion or doing this job in a better pace. Okay, so thank you. And whoever facing difficulty, please let me know. If any of you are facing difficulty with the link what I have shared, please let me know so that I can give my Google Pay. Let me also check whether any of you are facing difficulty. Let me see. Yeah, I could see Nidin Narayan initiated the registration. I could see Daniel initiated registration. Yeah. I could see Suman Mukherjee initiated registration. Vivek Patel cleared it. Okay, right. Now let's see who is in the process. Yes. Let me just call out. Kasturi, job is based in investment banking. Will these courses will be useful? Yes, absolutely. Except for one or two, those CIBIL report, the other things, all others are connected with financial analysis, and yes, they will help you. You can enroll very confidently, Kasturi Kasirajan. Yeah, what is the process for accessing the courses daily? I will be explaining. Just give me 10 minutes time. Once I complete this acknowledgement, I'll explain that, and you will also receive a WhatsApp message. Okay, through that you will have, or you will get all the information. Okay, yeah. We have our next participant. Yes, Suman Mukherjee. Suman Mukherjee, this is an acknowledgement message. Yes, I have received your fee. I have received your payment, and this is an assurance. Take it from me. This is going to be one of your finest investment. You will get a return on investment as early as possible, and this is something which you can look for all the time. Okay, even if you become managing director of a bank. Okay, that's the kind of assurance I am giving, and you are going to get 100 times of value. I am not exaggerating. I am not exaggerating because having trained more than 2 lakh students, I can say this with utmost confidence. I can say this with utmost confidence because that's the level of feedback, that's the level of reviews I have for these topics. Okay, so thanks a lot. Welcome to our banking students community. Please spend that 30 to 45 minutes every day. That's very critical and important here. Thanks a lot. Okay, let's move on. Let's see who else is in the process. I could see Om Prakash have initiated the registration. Nidin Narayan initiated. Daniel, I think Daniel is from outside India. Yeah. Om Prakash, yes, I have received. Let me just call out. Yeah, here we go. We have our next set of participants. Om Prakash Gupta. Om Prakash, thanks a lot. Thank you very much for the trust. Thank you for investing your hard-earned money. See, for some of you, it may sound like why I am repeating this again and again. My humble request, please allow me to say this. Okay, I want to thank each and everyone, and I want to specify on these words because I should stay loyal all the time. This is for me. Okay, this is for me. Uh, some can feel like, okay, let it be within why you are saying this. But when I say this, I'm actually saying this in front of several hundreds of executives, no? So that keeps me conscious. Yeah. And Suman Mukherjee is asking, in which platform you can attend your classes? See, all these are pre-recorded classes. You can access anytime, and please give me that 10 minutes time. Once I complete, I'll show you how you can access, and all of you will be getting a personal message from me after this webinar that will have all the instruction as to how you can access the courses, and you can always get in touch with me. Okay, is that okay, Suman Mukherjee? Yeah, here we have Om Prakash. Thanks a lot. Sorry, Om Prakash, just a minute. Nagraj, I have seen your message in YouTube. Just drop me a message in WhatsApp if you need to discuss. Yeah. Okay. So Om Prakash, sorry for that. Yeah, Bharati, you can go ahead. Om Prakash, this is an acknowledgement message as well as an assurance. Acknowledgement, I have received your fee. Assurance, this is going to be one of your finest investment. And as I said, this will give you value 100 times for the money you are going to commit. It's because several thousands of students have enrolled in our courses and have derived substantial value. They have confirmed that to me. Okay, it's available in public domain. Quite a few I have shared, just a few I have shared, but they have come back to me with that joy. Okay, probably if you came to know about me through some of your friends, you can vouch with them, and I would say you are the best judge to take a decision now because you have listened to me for the past 60 plus minutes. So I need not boast myself. You know whether I'm capable of teaching or not. So you have done that evaluation and you have taken a decision, and thanks a lot, thanks a lot. Thanks for the trust. Welcome to our banking students community. This is one of your best investment. Okay. In order to get the best returns out of this investment, please spend that 30 to 45 minutes every day. Please spend 30 to 45 minutes either in the early morning hours or in the late evenings, okay, or late nights, somewhere like 10 to 10:45. If you do that consistently for 11 days, it's going to become your habit. You will get best out of it. Okay, you will see a transformation, you will see a better version of yourself, and you will be able to achieve mastery in financial analysis. Okay, so thank you, Om Prakash. Yeah, we have our next participant. That's Nidin Narayan. Nidin Narayan, yes, thanks a lot. This is an acknowledgement. I have received your fee, and this is an assurance. It's going to be one of your finest investment. Thanks a lot for spending your time today. Thanks a lot for committing your hard-earned money. Please spend that 30 to 45 minutes. Okay, please spend that 30 to 45 minutes. It will make significant changes, and you will be able to achieve financial mastery. Thanks a lot. And Dipesh, yeah, Dipesh, yes, Paytm is available. It is 7736022001. 7736022001. You can make through Paytm. And Naveen Kumar, yeah, the link is already available. I'll give you the link once again. Naveen Kumar Chitta in YouTube. Just a minute, just give me a moment. I'm taking that link for you. Yeah, Naveen Kumar Chitta, I have given you the links. Okay. Yeah. Bharati, I will give you the confirmation. Just a moment. Just a moment. Yes. Let's see. Here we go. Bharati, thanks a lot. Thank you very much for your investment. Thank you very much. Thank you very much for your commitment. Thank you for investing your hard-earned money. Okay, and a warm welcome to our banking students community. See, please spend that 30 to 45 minutes. That's it. Do that consistently. You will see a significant transformation. Okay, thanks a lot. And my assurance, you will get 100 times of value. That's my assurance. Yeah, Bhardi. Yeah, Naveen Kumar, I'm giving you my number, 7736022001. 7736022001. Okay, so any of you still in the process of enrolling? Yeah, Bharat is asking how to access. I will show the process, and whoever have made the payment, whoever have registered, immediately after this webinar, you will be getting a message in WhatsApp. And if you don't have WhatsApp, you will be getting an email where a complete instruction as to how you can access the courses, how you can install our app, how you can get access to our Telegram group. Everything will be given. But even before that, before concluding the webinar, I will show you that as well. And I just want to know whether any of you are still in the process. Let me just check. Om Prakash, Nitin, everyone completed. Yeah, Daniel, I think Daniel from outside India. Daniel, I'll help you out, okay? And let me see who else. Vivek cleared. If any of you have made the payment through Google Pay or Phone Pay or Paytm, see, this is my number 7736022001. If any of you are making payment through Google Pay or Phone Pay, let me know, because I have to give you manual access. I have to give you manual access. And before I proceed with explaining the process of accessing the courses, let me just give you a code for claiming your webinar certificate. Okay, let me just give you a code for claiming webinar certificate. And just a moment. Yeah, here we go. See, I'm just pasting a link here. If you click on that link, it will take you to a form. If you fill that form, you can claim certificate. Of course, you will be getting a mail also, but this time I'm also sharing the link here in webinar itself. And in that form, you will be asked to fill a code. Okay, you need not fill the form, just copy the link or copy and open it in a browser. Once we complete the session, you can fill it. Okay, it will ask you to submit a webinar code. The webinar code is FA. The webinar code is FA250421. Okay, so only if you key in this code, you will be able to submit the form. It is FA250421. That's the webinar code. With that, you should be able. Okay, you should be able to claim webinar certificate. And okay, Aman is asking a video for budget analyst also. Okay. Yeah, Aman, you can just drop me a mail. See, this is my email ID. Yes, we have a course on that. enradca@gmail.com. Just drop me a mail. And whoever interested in enrolling, but you couldn't make it now, let's say you want to enroll at this concessional price, because it's basically a concessional price. You get how much? 20 courses, you get 15 resources, and all for a price less than 3,000 rupees. Okay, so whoever interested in enrolling but you couldn't make it now, but you want to make it for sure because you want to learn, you want to improve yourself, then drop me a message in WhatsApp. I have given my WhatsApp link. And when you can, that is maybe because of some financial constraint, if you could not take a decision, let me know. I'll try to provide some scholarship so that you can make it better. Okay, you can pursue your learning journey. Okay, so all of you, I have given my WhatsApp link. This is my WhatsApp link. And if any of you have made the payment through Google Pay or Phone Pay, let me know. Google Pay, Phone Pay, Paytm, and we also had inquiry from Kasturi. from investment banking, whether you could make it, let me know. See, as far as the price is concerned, this is highly underpriced, okay, highly underpriced, but it's basically to give you an opportunity to learn, okay. Yeah, Prakash, I am repeating the code is FA250421, FA250421. Okay, thank you, Kasturaj. Yeah, Naveen Kumar, I have received your message in WhatsApp. Okay, I'm just sharing the payment details for you. You can make payment through any of the options. And Kasturi Kasirajan, just drop me a message in WhatsApp so that I can give this reserved price. Okay, because otherwise, if you visit the website, you may not find this course at first, and you will not find it at this price as well. Okay, yeah. Okay, now, okay, so I have shared the link, and can I have your another 7 minutes, because this is what I'm sharing at the end of all my webinars. This 7 minutes, this is not related to any course sales, nothing. Okay, this is related to the important aspect of every employee and every businessman. That is how to increase your income, how to increase your salary income, how to increase your business income. Okay, and these are all not my words. I read in a book. I found that super useful, extremely powerful, and we have to implement that in our life if we really want to increase our income level. Okay, and these are all not stock market related thing, but it has something to do with our inner self. Okay, just type yes, just type yes. This will run for 7 minutes, but it will be worth your time. You have spent time from 11 to 1:30. Okay, another 7 minutes will give you that diamond finishing for that. Okay, just type yes. This will result in significant transformation. And these are all not my words. Take it from me. See, certificate, now you can just claim the certificate. Certificate will be issued only on Wednesday. Okay. We need 3 working days. We have to verify. We have to see whether the participant has attended the entire webinar. Only for them we issue certificate. Okay. So certificate you have to claim today. It will be issued on Wednesday. Yeah. Thank you. Now let me continue. This just shows some of the discussions happening in our Telegram group by our earlier students. I just took the screenshots. And after this comes our 7-minute presentation. Very important. Yeah, it starts now.
It's midnight 1 a.m. When I read this, I thought immediately I should convert this as a lecture for our YouTube subscribers. How to increase your salary or business income. Salary increment. This will be the wish of every employee. But many of them think that this salary increment is decided either by the economic environment or it is decided by superiors. But the fact is, it is decided by what we do or what we don't do. Our position, that is, in what stage we are, how we are, was actually chosen by us. If you are not satisfied with your current salary, if you're not satisfied with your current income in your business, then you have to ask your boss. You have to ask your boss. For that, you should stand in front of a mirror and negotiate with your boss. The person you see in mirror is your boss. This person only decides your salary. It means you only decide your salary, you only decide your business income. If your present income is not increasing beyond a certain level, it means you touched your highest level of income for the present skill and present knowledge you have. That means you have reached your maximum. So if you want to earn more, then you got to acquire new skills, you got to acquire new knowledge so that others will be willing to pay you more. And one good thing is you can become what you wish. But that requires some efforts. Efforts are basically you have to read more, you have to upskill yourself, you have to engage in continuous practice, continuous learning, and you have to continuously focus on progress. In this book, author talks about a research conducted by a professor of Chicago University. In that, what they have found is 80% of people register only 3% annual increase in income, whereas 20% of people recorded 11% annual increase in income. So whoever coming under this 80%, they had only 3% annual increase in income and they never progressed. They always worried about money. They had shortage of money at the time of their retirement and they never learned anything new since their first job. They never read anything new. They never learned any new skill. They didn't bother to upskill themselves. They were doing same or routine job again and again. And people around them also never read anything new. They had no improvement. And because of this, they believed that others are also living in the same way. They believe the lifestyle of others is also similar like this. So that's about 80% people. Whereas remaining 20% people, they had 11% annual increase in income. How? All of them were lifelong learners. They read something about business. They always read something about self-development. They participated in seminars, workshops to improve their skills. They networked with like-minded people. They discussed which makes them better. They discussed about ideas and insights which will help them to achieve results at a faster pace. So, if you want to achieve higher income, whether it be in the form of increment in salary or increase of income in your business, you have to become a lifelong learner. So how to become lifelong learner? Author prescribes 3 steps. To become lifelong learner, he is suggesting 3 steps and these steps will bring total change in the way you attract higher income at a pace greater than you think. What are those 3 steps? Let's see one by one. Step number 1, you have to read. You have to read daily at least 1 hour every day something related to your field. You have to spend at least 1 hour every day in reading matters related to your field. It can be related to your job, it can be related to your business, and when you do this, please keep away newspapers, magazines, TVs, computers. Put your entire focus on reading. Anything that helps in improving your job, improving your business, keep this, make it as a daily routine. If you do this at least 1 hour per day, you will be able to read 1 book at least per week. It means in a year you will be able to complete 50 books. If you want to get PhD in a top university, you have to read and research 30 to 50 books. But by reading 1 hour per day, what you're going to get is new ideas. And by planning how to implement those ideas in your job, in your business, you will get results, and that is something equivalent. That is, your reading becomes equivalent to a PhD. So that's step 1. What is step 2? You have to listen. You have to listen to audiobooks. You have to listen to audio lectures. Nowadays, we can also include online courses. You have to listen to them at least when you travel. That is, when you don't drive, when you are traveling, make use of your smartphone and listen to them On an average, 500 to 1000 hours of businessmen or working executives are spent on travel. That's equal to 12 to 24 working weeks, or that can be equated with one semester in a university. So make best use of this time to listen to audiobooks, lectures, online courses related to your job, related to your business. Step number 3, go back to learning. Whenever you get training, whether it is your internal training or external training, attend and learn. And if required, you should even pay and learn more. If you have decided what level you should achieve, then you have to find out what and all you should learn so that you can achieve that targeted level. And you should master time management. You should master negotiation skills, discussion and conversations. You should achieve expertise in goal setting, finding solution for problems, strategic planning, and you got to acquire new skills that could lead to faster growth. So these 3 steps are very critical if you want to become a lifelong learner, and only those who become lifelong learner will be able to increase their salary or business income. I've read this in a book called Personal Success.
Yeah, I read this in a book called Personal Success, and this is something which all of us have to imbibe. We have to take this deeper. I mean, when you apply this principle, you will see transformation happening. Okay, you have to keep on be learning new things. Only when you put a full stop for that, you will get stuck. Okay, but if you keep learning new things, you will always find a way to grow. So if you find this useful, if you find this message useful, type useful, or if you find it super useful, type super useful. I always find this super useful. And every time when I play for you, I listen to this. And this tells me that I have to keep on be learning new things. Okay, so if it is super useful, type super useful. Be a lifelong learner. Okay, if you want to get into that 11% annual increment in salary, and if you are a businessman, if you want to see a rapid growth, okay, be a lifelong learner. Thanks a lot. And if any of you missed any part of today's session, we'll be repeating this tonight 9 p.m. You can join. And if you found the session useful, please tell your friends, colleagues, just ask them to visit our website, CA Raja Classes, or let me give you the link. You can share with them so that they can attend our 9 p.m. webinar. Okay, I'm giving you the link. Just copy the link and paste it or share with your friends. This is for our 9 p.m. webinar. Okay, do this only if you find this session useful and helpful. Thanks a lot. And I said I'll show you how to access the content. Let me do that. Yeah, just a moment. Okay, I'll show you how you can access the content. See, basically the site is courses.carajaclasses.com. Okay, I'm just opening it. This is our e-learning portal, courses.carajaclasses.com. Or let me give you a simple shortcut. Okay, why to complicate? See, all of you would have received an email, right? Yes, all of you received email, right? With this one, invoice details of your order. Okay, so go to that email. Here you can see, you can access the courses on our website here, courses.carajaclasses.com. Simple. Just click on that. It will take you to our e-learning portal, that is courses.carajaclasses.com. On the top right, you will find this button, login button. Okay, click on login. It will ask for your user ID and password, basically your email ID and password. Click login. That's it. You will get inside, and after login, here you will see my courses. Instead of courses, you will see my courses. Click on my courses. You will see the courses you have enrolled today. Okay, as simple as that. Is that okay? Is that okay, all of you? So how to get this link and all, just go back to the mail. Just go back to the mail. You would have received an invoice mail, because what I have received here is the copy. Okay. So you would have received an invoice mail like this. Go and click on this. You can access the courses. And if you have any issues and all, you can always get in touch with us. Okay. Fine. I hope the time what you have spent is spent wisely. And if you really enjoyed today's session, you can say time wise spent, and you can say goodbye and leave. Time wise spent, or TWS. Yeah. Thank you very much. Yes, Suman Mukherjee, for working capital business, collateral plays a very vital role in credit decision. Yes, collateral plays a very vital role, but generally the sanction is like this: the financial sanction or collateral, whichever is lower. So since because they have higher collateral, it will not give them higher working capital credit facility. Is that okay, Suman? And yes, since you are in our student list, you will be getting a notification for our working capital webinars also. Okay, Suman is asking. Okay, Suman, I hope you have enrolled, right? You have enrolled today. So within that package, there is a session. Yeah, within that package, there is a course called Banking Credit Analysis Process. In that, there is a dedicated section for working capital. And there is a course called Learn Banking Credit Analysis through Case Studies. So there is a dedicated case study on working capital, where you will see the impact of financial sanction, LTV, whichever is lower, all those aspects are discussed. Okay, fine. So all of you will be getting a WhatsApp message. You will also get a email confirmation. Email confirmation, all of you received. You'll be getting a WhatsApp message, and that will have a link for the mobile apps and Telegram group link. Okay. Shall we wind up? You can say bye and leave uh, gradually. Yeah. Thank you. Thank you, Swarda Kulkarni. Thank you, Baba Krishnan. Suman Mukherjee, thanks a lot. Gopal Krishnan, thank you. Prasad, thank you. All of you, just spread words. Okay, just tell your colleagues that here is a guy, CA Raja, he is doing this so that they can also attend our webinars. And for us, this is our core operation. Okay. Yeah, thank you, Rajiv Singh. Thank you, Apurva. Thanks a lot, all of you. Thanks a lot. Thanks for your time on this Sunday. Thank you. Yeah, thank you. Thank you, Suman Mukherjee. Thanks a lot. Aman, thank you. Bharati, thank you. Thank you, Ashish Kumar. Thank you, Tilak Raj.